All right, welcome back, fail-safe investors. Welcome back to another video where we talk about stock and how to progress your portfolio and how to grow your portfolio and all the things that's covering stock right now. So on today's topic, we are moving on to the next edition of the financial statement. If you haven't watched the video that I did on the balance sheet, I'll leave the link in the corner up here or probably in the description down below, probably both, I don't know yet. But this is pretty much a continuation of the financial statements, and then the second financial statement is the income statement. So if you don't know the financial statements for any company that you're looking into, I've mentioned in the previous video that you can find the financial statements on the investors relations page or on sec.gov. The 10K, so you type in the ticker symbol and you look for the 10K form, which is the annual report, and you'll find the balance sheet, the income statement, and the cash flow statement on any annual report that you pretty much look into. I personally use Fidelity to look into the financial statements because they have a link that just says financial statements, and it shows the balance sheet, the income statement, and the cash flow statement pretty much in their own format, and it's easier for me to read that information and analyze it there. And usually I cross-reference it with the investors relations page or the 10K, and the information is generally on point always. Let's go. So a preface to this video, I should tell you up front that when you are looking into balance sheets, income statements, and cash flow statements, since you're dealing with billion-dollar companies, most of the numbers will be represented in the form of millions, and you will see that on the balance sheet. They'll give you that notice. They'll say most of these numbers, or these numbers are represented in millions. So that first number, if you see just one, that's $1 million. So anything past that first comma, you might think that's $1,000. That's actually $1 billion. So that's just to make this video easy for you to understand what I'm telling you. We're gonna go line by line with an income statement, 2 income statements to be exact. I'm gonna give you an income statement of a company that is, I would consider, a great income statement and financially responsible and pretty much a really solid company. And then I'll give you a company that is not so great, not so large. These are 2 different companies in 2 different sectors, 2 different forms of income. It's going to be company A and company B. I'll release the information. I'll tell you which these companies were at the end of the video, but I'm going to go line by line, and then at the end I'm going to tell you what lines I specifically look at when I look at an income statement, because I know what I'm looking for. So I'm trying to give you that information so you could avoid all of these mistakes. You can go straight to these lines, but you still should know what every line mean, right? So we here today, we're here to do some accounting. I have to put on the suit and tie for you guys, and I'm ready. Are you ready? You ready? All right, let's go. We're gonna do this line by line, and starting off with the first line, we have sales and turnover. So to translate that easily, sales means revenue. So that's all the money that was brought in by the company. So company A has a sales of $274 billion. That's right, $274 billion. Company B has a sales of $37 billion. So I have my notes right here because I'm not Rain Man. I can't remember all these numbers. I have to write all these down and do this for you guys so I can have my information on point, right? So we're gonna go line by line, and that's line number 1, sales. Sales equals revenue. That's all the money that was brought in. So right under line number 1, which is sales, is usually cost of sales, which is the money that the company had to spend to produce the product that it is selling, right? Company A has a cost of goods sold for $158 billion. So they spent $158 billion to make a $274 billion. Company B has a cost of goods sold $13 billion. So they spent $13 billion to make $37 billion. Line number 3 is gross profit. So line number 3 is pretty much you subtract the cost of goods sold from the sales and you get gross profit. So company A for gross profit has a gross profit of $116 billion. Company B has a gross profit of $23 billion. So it's simple math, right? You pretty much going line by line and subtract. You're subtracting each line in succession from the previous line. It really is that simple, right? Line number 1, sales. Line number 2, cost of goods. Line number 3, gross profit. Line number 4, then we have selling and general and administration. So that's pretty much what they spent on like marketing and things like that. So most of these lines are self-explanatory. It explains itself. So selling, general, and administrative, that is like marketing, research, all of that stuff. So company A has spent $38 billion on sales, general, and administrative expenses, and company B has spent $12 billion on that same line, right? So when you subtract all of that, you have your operating income before depreciation and amortization. So I want to stop right there before we go into depreciation and amortization. So what you have from that first bracket, what you have left over from company A will be $77 billion. And from company B, you have $11 billion left over, right? Before you go into depreciation, amortization, we haven't even gotten into taxes, interest on loans being paid, extraordinary items or special items. We haven't gotten into any of that yet. And we're already pretty much out of pocket a lot of money. Let's just like a lot of money. We went from $274 billion to $77 billion on company A, and then we went from $37 billion to $11 billion on company B. And you might be shocked at which company is which, right? But I'll tell you at the end of the video. So then we go into depreciation and amortization. Depreciation and amortization is, depreciation is you writing down the book value of a fixed tangible asset on your income statement over the course of the life of that product. So if you have a bottling plant or something like that, all of that equipment is fixed assets. So you would have to, instead of paying for all of that up front, you pretty much will put the money on your balance sheet, and then under the depreciation line, you will slowly just write off the book value or write down the book value on your income statement. And then it's kind of like writing it off on your taxes. And amortization is the same thing, but just for intangible assets. So you're doing the same thing with amortization, but you're just doing it with intangible assets. So remember that depreciation is tangible assets that you're writing down, and amortization is intangible assets that you're writing down. So that's intellectual property and things like that. So when we subtract depreciation and amortization from company A spends $11 billion in 2019 versus company B, which spent $1 billion in 2019 on depreciation and amortization. So when we subtract that, company A, we're left with $66 billion, company B, we're left with $10 billion, right? Then you have interest and related expenses. So interest and related expenses is the interest that these companies pay on the loans that they still have outstanding. So if a company borrows money, you know, because companies do have credit ratings just like you and I. So if they borrow money, they still have to pay interest on that money. And in the current climate that we're in now, you will probably see a lot of companies, probably any company that you're looking to, borrowing more money just to shore up money right now, just in case we go into like another lockdown or anything like that. So they want cash on hand. So they're gonna borrow money, and the interest loans that the Fed is giving on money right now is so low. I don't blame a company for borrowing money. So that's never been my problem. I know I talk about debt a lot on balance sheets and things like that, but at the rate that you can borrow money right now today at so low prices, I don't blame you for wanting to borrow money at the interest rate that you can get it at right now. And then with the inflation on the dollar, it's easier to pay off that debt in the future, right? Company A has $2.8 billion interest that it paid in 2019, and company B has $946 million. So then we subtract that. Then the line right under interest and related expenses is non-operating income. So that's money that the company is receiving outside of its core business. So that could be from investments, from other companies, things of that nature, right? So company A received $3.6 billion in non-operating income. Great. Company B has received $1.1 billion in non-operating income, right? When you go under that line and you have interest being paid on that non-operating income. So that could be the company loan another company some money or things of that nature. So like most of these terms are pretty simple. I just want that to like click. Like this isn't complicated. This isn't some special language that I'm speaking. These are like common terms that you and I may use in our everyday language sometimes, like interest and things like that. So the interest income for company A is 0. So they probably don't have investment, or they probably don't have any money that they lend out. But the interest on company B is $563 million. Remember that. So the line under that would be special items. Now I want you to pay very close attention to that. Special items is items that you spend money on that should not be reoccurring on your income statement. So this is something that you might do or spend money on for your company. It's something that usually outside of the norm of your business operation. That's why it's called special items. So when you're looking at an income statement, when you look at special items, you do want to kind of go back or backtrack, last couple years. And usually when you're looking at an income statement, most income statements, no matter where you look, will either show the previous 3 years, or Fidelity uses 5 years. So that's also why I use Fidelity. So for company A, they have $0 spent on special items, right? Great. You don't want your company spending anything on special items, let alone continuously, right? Company B received 11 million on special items, and the year before that they spent $1.4 billion on special items, and the year before that they spent $3.7 billion on special items. So I'm just gonna tell you right now, for me, those are big, huge red flags, because you wouldn't want these to be reoccurring on your income statement. It's just like your friend who he knows his expenses and things like that, but he likes to party every now and then, and he spends hundreds of thousands of dollars on parties or things like that, or things that he should not continuously be doing, and he continuously do it. And then he comes to ask you for money, or he says he's in a bad place financially. Well, you kind of seen that train wreck coming. So you gotta think of it like that. We continue down. So the line under that, you'll usually see like another checkpoint, and then that checkpoint will be like pre-tax income. So that's pretty much where we're at after we subtract all of those other lines from that $274 billion and that $37 billion. So for company A, right now we have $67 billion, and for company B, we have $10 billion, right? So this is before we go into like income taxes, extraordinary items, preferred dividends, things like that, and I'll explain all of that. So just making sure you're still here with me, right? Okay, income taxes. So on Fidelity, it's kind of like a dash. So it doesn't give you an exact number, right? And it's for both companies, company A and company B. It doesn't give you an exact number, but simple math, where we just subtract, we were able to get to this number. So just hold that thought in mind, right? Income taxes. Remember I said before income taxes, we had $67 billion for company A and $10 billion for company B. So simple math, I just kind of subtracted that 57 from that 67, and it was a little over 9 billion, because these are like rough numbers. I'm pretty much rounding these numbers up and down. So it was a little over $9 billion for company A that they spent on income tax, right? And then for company B, since they had a minority interest in a company that they received $65 million from, they actually paid $1.8 billion in income taxes and was left with $8.9 billion in income before extraordinary items and all of that stuff, right? So pretty much from here, it kind of gets simpler. If you notice, like, that number isn't really going to change. So company A has $57 billion before extraordinary items and things like that. And company B has $8.9 billion before extraordinary items and things like that. So under that will be like dividends, but it's dividends for preferred stock. So neither one of these companies have preferred stock, so they don't pay a dividend on preferred stock. So how dividends work, if a company has preferred stock, usually the dividend is paid on the preferred stock before the common stock. It's not guaranteed to the preferred stock. So there is a misconception that people think that if they have a preferred stock that a dividend is guaranteed. It's only guaranteed before the common stock. So a company do not have to pay you a dividend even if you have a preferred stock. It's just guaranteed before the common stock. So neither one of these companies has a preferred stock, so that line is 0 for company A and company B, so they're still at $57 billion for company A and $8.9 billion for company B. The line under that would be like common stock equivalents. So that would be anything that these companies would give out to people that can be exchanged for the equivalent of a common stock. And same thing, both company A and company B 0, so we're still at 57 and $8.9 billion, right? Then you have extraordinary and discontinued items, and again 0 and 0. So then we get to pretty much the bottom line. So the top line for company A was $274 billion, and the top line for company B was $37 billion. The bottom line for company A is $57 billion. So $57 billion for company A is what they were able to retain after they did depreciation, the cost of goods sold, the income taxes, the interest on the loans, all of that stuff. $57 billion isn't bad for any company, right? Company B was able to retain $8.9 billion, right? So if you were wondering what these two companies were, company A was Apple, which has a valuation of $2.1 trillion. Huge company, right? And company B was Coca-Cola. Now I want you to think about something, and I want your honest opinion, and I want to see like you comment down this below. Which one of these two companies do you think have more longevity, and which one do you think has more brand recognition? Now I'll give my opinion. I think Coca-Cola probably has more longevity just because how long they've been around. Their brand is big, probably bigger than Apple, I'm just gonna be honest. And they are number one in the sector they are in. They are the world's largest beverage manufacturer. Just think about that. With no one coming close to them at all. So that's why I say Coca-Cola has more longevity in my eyes than Apple, because yes, Apple is in the tech sector. They are killing it right now. They have their own ecosystem, but people's sentiment towards Apple is kind of waning. And in the tech sector, something new can come along. There is a possibility, and tech goes like that. So I'm not saying that it will happen, but there is that opportunity for that to happen, versus Coca-Cola, where I just don't see that opportunity. Even though Apple is a $2.1 trillion company and Coca-Cola is a $228 billion company. Big difference. Apple does make the revenue to justify that valuation, and they also retain the money to justify that valuation. And Coca-Cola, the sales is going down. If you look at the previous 5 years for Apple, the sales have been going down slowly but surely, and that's due to management. I'm just gonna be honest, but I still will say Coca-Cola has more longevity. Now, I'm gonna tell you the items that I personally look at on any income statement for any company that I look into. Number one, the top line, sales, revenue. How much money is this company making in revenue? I look at the second line, the cost of goods sold. That's important. How much money are they spending to make that money? And then I look at special items, because that's very important. That lets me know what the management is doing. And when you start to see those numbers like 3.7 billion, 1.4 billion, it's like, it's not good. Oh, I should also mention it, if you see a number in parentheses, that's money that was paid out on the income statement as an expense, not, you know, pretty much how they usually do it. And the last, so after special items, the last thing that I would say I look at was pretty much the bottom line, the net. So how much money are they keeping after they pay out all the taxes and all the other stuff. I'm not gonna say those other lines aren't important. I'm just telling you what I personally look at, but I wanna know your opinion. Are you looking into financial statements? If you aren't, why aren't you? Are you subscribed to my channel? If you aren't, why aren't you? If you don't like this video, why don't you? Let's talk about it. To the next one though, let's do it. Peace.